Hello and welcome to the Lolly Investor Programme. Well, the summer is definitely over. As I thought about this week's topic, all the wet weather we've been having reminded me of the nursery rhyme about Incy Wincy the spider. Incy Wincy shows great resilience in climbing the spout again and again after each downpour of rain. Just like investors. In the past 12 years, investors have been washed away by a series of downpours, culminating in the 2008 financial crisis from which we're still recovering. After each shower, however, comes the sun, and drying up some of the rain for investors in recent years has been the re-emergence of a classic way of investing in the stock market. It's called equity income investing. Equity income investing is about buying shares in well-managed companies that pay good dividends to their shareholders. Good doesn't necessarily mean big, it means sustainable and dividends that grow above inflation. If you're a DIY investor, you can build a portfolio of income stocks on your own. Alternatively, you can invest in one of the many equity income funds that will do the job for you. The great news for investors is that companies in the UK are generally good at paying dividends, and the dividend culture is spreading to the US, where companies are also very good at rewarding shareholders, and to Europe and Asia. This means that there is a growing number of global equity income unit trusts and investment trusts that you can choose from, alongside the more traditional UK equity income funds. Dividends are a crucial part of the total return investors can get from the stock market. £100 invested in the UK stock market at the end of the Second World War would be worth around £7,400 today if you'd taken the dividends and spent them. However, if you'd reinvested the dividends back into the stock market, that £100 would have turned into over £130,000 today. Here's another statistic. The UK stock market has generated an average annual return of nearly 5% over inflation since 1970. Most of that return has come from the initial dividend yield that investors would have got when they invested 42 years ago. Let's remind ourselves about dividend yields. The dividend yield is a percentage that measures the amount of dividends you get for every share you own. Dividend yields move in the opposite direction to share prices. So, if a company's share price falls and gets cheaper, and it maintains the level of dividend, then its yield will rise. The higher yield means you're buying more dividends when share prices are low. In other words, this brings us back to the fundamental rule of investment, which means that you should buy when prices are low and sell when prices are high. Which brings me on to the second piece of good news, which is that at the moment the UK stock market is relatively good value. One measure of this is the fact that the UK All-Share Index currently yields 3.6%. By contrast, government bonds, which are a traditional source of reliable investment income, yield only 1.3%. In other words, government bonds are expensive, but shares are quite cheap. Moreover, big companies are cash rich at the moment and should be able to continue paying dividends that grow above the rate of inflation, unless we fall into a really serious recession. To sum up, now is a really good time to get into equity income investing. If you're a younger person looking to grow your money over the long term, the equity income approach is a tried and tested means of generating a good total return. If you're an older person needing the investment income, the equity income funds can be a solution, although there's always a risk that a stock market crash will make a big dent in your capital. Like Incy Wincy, there's always a danger that markets will send you tumbling again.